Now friends, another significant value of income elasticity is that of unity. That is, when income elasticity of demand is equal to 1, the proportion of income spent on goods remains the same as the consumer increases. This represents a very useful dividing line. That is, if the income elasticity for a good is greater than 1, it shows that the good is bought in larger quantities by the consumers. That is, he spends a major portion of his income when he becomes richer on buying those goods. Such goods are called luxury goods. On the other hand, income elasticity, if it is less than 1, it shows that the good is either relatively less important to the consumer, it is a good which is necessity. Now we take the earlier example of wheat, TV and bajra or buttons, and we explain the same concept to still make it clear. The formula, as I told you, income elasticity EI is equal to percentage of change in demand divided by percentage of change in income. See the table that has been given in page number 2.40. The following examples have been taken. Now the commodity is wheat. When the household's income is raised by 10%, the demand for wheat increases by 5%. So applying the formula, 5% divided by 10% is equal to 0.5, where the E1 is less than 1. So here wheat is a normal good and fulfills a necessity, so the elasticity is less than 1. Whereas in the next case, even if there is an income of 10% rise in the income, the demand for TV rises by 20%. Just a slight little increase in the income had made the consumers move on for TV more. So applying the formula, 20% increase in the demand for TV divided by 10% of income gives you the quotient as 2. Now E1 is greater than 1. So when it is greater than 1, the commodity is a luxurious commodity. Next, going to bajra, we see that the household now is ready to spend only 5% of his income, whereas the demand falls by 2%. When the demand falls by 2%, the income elasticity becomes negative, where E1 is less than 0, that is -4. So we can understand that it is an inferior commodity. He is ready to go in for any other commodity instead of bajra. Next, for another product whichever the household is ready to buy, say the product X, 7% increase in his income makes him move to 7% increase in the product, that is equal to 1. That means here it is unitary income elasticity. When it is very, say not a common product, say buttons or any other product which is not often purchased by him, there is no change in the increase in demand, whereas his income increases by 5%, then E1 is equal to 0. That means ordinary products, they don't have any income elasticity. So here it is to be noted that the words luxury or necessity or inferior goods do not strictly mean the same meaning for economics. Here in economics theory, we distinguish in the manner shown above, that is due to the table. Income elasticity usually differs in the short run and in the long run. For nearly all goods and services, income elasticity of demand is larger in the case of long run than in the short run. Because when there is enough sufficient time and there is a change in the income, the tendency of the consumer to move towards the product, the demand to increase, is more than in the case of short period. So knowledge of elasticity of demand is very useful for a business firm. How and why? Because it can estimate the future demand for its product. The knowledge of income elasticity of demand helps the firm to measure the sensitivity of a sales for a given product, or to raise the income of the to raise the sales according to the income of the society. The outcome of the business cycle on the whole as for the market demand. For instance, if EY is equal to 1, sales move exactly with the changes in income. If EY is greater than 1, sales are highly cyclical. That is, whenever the change is there in an income, the demand also is changing. But for an inferior goods where EY is less than 0, it is counter-cyclical. That is, it is moving in opposite direction. So for the business firm to make appropriate planning for production and to manage the cost effectiveness, it needs to understand the elasticity of demand with regard to income. You have certain illustrations to explain this. Let me help you with the illustration number 6 here. A car dealer sells two types of cars, that is new cars and used cars. When the price of the new car is 6.5 lakhs, the quantity demanded was rupees 400. When the dealer is selling used cars at 60,000 rupees, there was a demand for 4,000 cars. But in the previous year, the customer's income rose up to an average of 10%. So when the income rose up to 10%, the last year's sale of the new cars increased from 400 to 500, but sale of used cars declined to 3,850 from 4,000. This is the case that has been given. Now you are asked to find out the income elasticity of demand for the new and also for the old cars. What inference do you draw from these measures of income elasticity? Now let us say the percentage of change in income has been given as 10%. Percentage of change in the quantity of new car demanded has been given as from 400 to 500. That is 25% increase. So income elasticity is 25% divided by 10%, that is 2.5. So new car demand has increased and due to the income. So here it shows a rise of positive 2.5, that is more than 1. So it means that it is highly elastic. So new car is a normal good. Whereas when we compare for the used car, again the percentage of income is 10%. The percentage of quantity in the old cars demanded is, it has reduced to the extent of 3,850 from 4,000. So the percentage is minus 3.75. That means it is an inferior good. It is a negative impact. When the consumers get a higher income, they tend to go for new product instead of old product. Old product is an inferior product, used product. So they are ready to go for the new product. Hence here the income elasticity is negative. That is what is the inference and makes us understand. Now with this we move on to the next topic in the next session.